This week on Wall Street Wrap-Up, if you thought inflation was on the ropes and getting beat, new CPI numbers out this week may make you think twice about that. So how will this affect interest rate cuts that we were all hoping for in the next few months? And Warren Buffett's Berkshire Hathaway is selling some stocks and buying others. So just what is Warren doing so we may rethink our own portfolios? And how will the new CPI numbers and the new year, how should we invest? Tonight, we're going to be talking with Sandy Villere, portfolio manager of the Villere Fund and partner at Villere and Company. We've got a lot to cover for the next 28 minutes, so join us because this is Wall Street Wrap-Up. Hi and welcome. I'm Andre Laborde. Hope you had a great week. Now, before we get to our show for this evening, an update on last week's show with Larry Adam. Larry's the Chief Investment Officer at Raymond James. And Larry said in our February 9th show that he sees a recession, possibly a small one, in the second quarter of this year, which is going to start in April. Now, this week, retail sales for January were released, and sales were, as they say, less than expected. More companies are laying off workers as the economy is starting to slow down this week. In fact, Morgan Stanley's wealth unit is seeing a downturn and is going to be laying off employees. And from the Bureau of Labor Statistics, with larger than expected job growths, but what's not being reported when you dig deeper are the kinds of jobs. We've added almost 900,000 part-time jobs that were reported, but we lost close to 100,000 full-time jobs over that same time period. Larry Adam also said from last week that travel and leisure for this year will be slowing besides. And with the hotter than expected CPI numbers for January causing a sell-off, thinking that the Federal Reserve will delay in lowering of interest rates, stocks fell in late-day trading. All stock indexes ended lower for the day and also for the week. Higher for the day were materials, healthcare, and communication services. And the Dow Jones closed lower for the day and also for the week, as well as the S&P 500. They also ended lower for the day and also for the week besides. Well, this week, the Dow Jones, they closed down 0.1%. S&P closed for the week down 0.4%. And the NASDAQ, they closed down 1.3% for the week. Warren Buffett with Berkshire Hathaway, according to their latest 13F filings, announced that they were cutting their positions in Apple, selling 1 million shares of the company. But then that's only about 1% of their holdings of Apple. Also cut in Berkshire are HP and Paramount Global, but added last fourth quarter are oil companies Chevron and Occidental Petroleum, where by the way, he also already has a very large stake in, as well as Sirius XM Radio. Now, as a reminder, that this is from their 13F filings of last fourth quarter of 2023. So since then, they could have either added to or sold from their positions. And credit card delinquencies grew last year as more Americans are living on credit cards, growing last year to now 8.5%. And auto loan delinquencies have risen to 7.7%. And the Consumer Financial Protection Board said this week that some of the larger issuers of credit cards offer the worst or higher rates. They reported that 15 issuers of credit cards with interest rates above 30%, including even big banks as Capital One, Citibank, TD Bank, and the USAA Federal Savings Bank. So, is the economy in a slower pace than the original data suggests, or are we headed toward a recession for this year? Tonight, we've got portfolio manager of the Villere Fund and partner of Villere and Company, Sandy Villere. Hi, Sandy. Welcome back to Wall Street Wrap-Up.
Thanks for having me, Andre.
On 60 Minutes, the chairman of the Federal Reserve, Jay Powell, was on, and he kind of threw cold water on the markets when he said that the March meeting, they will probably interest rate reductions will be off the table. Now, the next meeting after that is going to be April and May. Do you think that, and the market went down right after he said that following Monday. Do you think that whether it's the March meeting or April or May or whatever the next 2 to 3 of this year, will it have that much of a difference?
Yeah, I mean, really, when you look at it, used to be sort of, bad news was good news is bad news, and all of a sudden you get that really hot jobs number, right? Added
Hmm.
353,000 jobs.
Mm.
Wage inflation is strong, up 4.5%. GDP growth is still strong. So I think when Powell's looking at everything, he's saying this economy is still pretty hot, and I really want to get to my 2% inflation target. So I got to keep rates, unfortunately, elevated a little bit longer than maybe people thought. So if that March meeting was a 52% probability, maybe now it's down to 10%. And I'm thinking it's more like zero. So I think it does get pushed out more to May. And then we'll see, do you get 125 basis points or 1.25% cuts in 2024? Is it more like 1% or 1.5%? But it's going to be very data dependent. So as this strong economic data comes in, it's probably not good news for those that want lower rates and a stronger kind of economy, really.
Hmm. We'll have one in March, and we'll have one in April before the meeting of whether to lower on that. Do you think? I know that the Federal Reserve is very interested on not being political. They want to be non-political. And if they keep things, if they start lowering rates as it gets closer to the end of the year, we've got the election coming up in November. Are they more concerned about keeping rates higher, as you said, because of inflation, or being looked upon as maybe favoring one party and candidate over another party and candidate?
Yeah, I think the Fed is going to continue to try to be as isolated and independent as humanly possible, and that's what Powell even said on that 60 Minutes interview. Is he wants to just steer clear and do what he thinks is right to get down to his 2% inflation target. So I think he'll stick with that. But certainly any decisions he makes are going to move sectors. They're going to move certainly move markets, and just got to pay attention more than ever maybe to the data. And I'm a stock picker, right? I'm just looking at individual companies, and now I've got to worry about the macro. So I think we're all watching these jobs numbers to see where rates ultimately end up and how quickly they do lower them.
Well, speaking of picking stocks, about a week ago, On Semiconductor released their fourth quarter earnings, excuse me, and they blew past the estimates of the analysts, and it was one of the largest increases. I think they rose like something like 10% on Semiconductor. Well, and I bring that up because when you and I were last together, you're on the show, you had two stocks that you really liked. One was Freeport-McMoRan, and the other was On Semiconductor. But now we're in a new year. We're in 2024. What are your thoughts about those two stocks or other ones that you like?
Yeah, I mean, it's interesting from looking at onsemi and Freeport. The one common denominator they both have is sort of a play on electric vehicles. If you look at Freeport, electric vehicles tend to use about 3 times as much copper as a combustion engine car. So, auto's been a little bit weak. And so, Freeport has that going on for it. But again, if rates do go lower, very good for, economic stimulus. And I think that could be great for Freeport. Also, weakness in China. 52% of the world's copper demand comes from China. So that's kind of kept it under wraps a little bit. But I still like Freeport a lot, good cash flow characteristics. And then looking at onsemi, they also have exposure to electric vehicles. And so Hassan Al Khoury, the CEO, has just done a great job going from more commoditized parts of their business to things that are, like silicon carbide that is going to be, higher margin and stickier and that sort of thing. So they had a nice quarter. The stock did jump up 10%, and I still think we're on the right company there. And it doesn't have that. It's not a Magnificent Seven stock. It's not a everybody clamoring over it, and it's not extremely overpriced like some of those other names. So I like this to get exposure to technology without overpaying for it.
Does it concern you any when we're talking about EVs, electric vehicles, that a lot of the electric vehicle sales, and I'm talking about with the major companies of Ford, General Motors, and also Stellantis, have not been going as well as they were hoping to. Now, Tesla is a different story because it's sort of like when you think of EVs, you automatically think of Teslas. Do you think that it will eventually catch on to being able to, what you're talking about with copper and other lithium and other components that you need for EV sales?
Yeah, that's really the EV sales been a little bit weaker is kind of what has hurt Freeport and onsemi. But I'm still quite positive over the long run that there's going to be a lot more electric vehicles than there are today. certainly Tesla has a lot more competition from all the companies you just mentioned. So we think it's going to work well, and certainly with Freeport, you get the electrification of everything. So as things, power grids and wind and solar and all these other things happen, we just think it's going to be really have the wind at its back.
Well, from the beginning of the year, Tesla has really, you talked about the Magnificent Seven, and one of the seven was Tesla. Well, of all the seven, Tesla is the one that's really been getting some gut punches because their fourth quarter earnings were reported, and instead of having 50% margins, they were like 38% margins, which is still good, but it was still about a 12% decrease. And then, of course, with Elon Musk, with some of the things that he's been talking about, is this a time to buy or bail?
Yeah, I would still bail on Tesla. And in fact, I'm really, other than maybe Microsoft of the whole group, we did own some Apple and got out of it. Still an incredible company. They're all incredible companies. I think they're all just a little bit too expensive for what I'm willing to pay. I mean, if you look at 20-year averages on, that growth index, probably the 20-year will be about 18.9 times. That growth index is now trading closer to 27 times, where you look at smaller caps and you look at that benchmark, the 20-year average was more like 16.7 times, and it's only trading at 16.1 now. So I just think there's better opportunities in smaller cap companies that are growing quickly, that just aren't as overpriced, and sure, they're not as fun sometimes because you don't get to read about Nvidia and all these other stocks every day they're doing great things. But I think a lot of those names are priced for perfection, and maybe Tesla's the first one to fall from that grace.
From those seven stocks that may start to slow down in growth as well?
Yeah, I really do, and especially if you have interest rates that were supposed to go down a little bit quicker this year, and they don't really, maybe until mid part of the year or back half of the year. Technology stocks do not do well, when rates are kind of lifting a little bit, and we certainly saw that in 2022 when the market was sort of discounting 11 rate hikes, and technology and growth stocks were off, 30% plus. And so in 2023, they started to discount that rates were going to go lower, which ultimately they may still, but I think you're going to get a stalling out this year of a lot of those, large cap, magnificent six, let's call them.
Right.
And I think that's going to be tough for those names when there's other opportunities in the market, and you could get a little bit of breadth and things spread out a little bit, which I think will be very positive for the markets as well.
Well, we hear a lot about AI, artificial intelligence. So let's say, because I get emails myself, and I know with all your clients, I'm sure you get asked about this. For those that may want to be involved with AI, and we're talking about maybe the Russell 2000, small cap stocks and such, is there a way to play the AI while at the same time not go with, we talked about the Magnificent Seven, or for other large cap stocks?
Yeah, I mean, I just think that when you look at certainly Nvidia, that is the best way to play it. But I just think it's expensive. It's like 32 times maybe 2025 numbers, and it's tough for me to invest after the run that it's had, up 35% on the year already. But again, they've only probably scratched the surface of maybe 5% penetration of that CPU market. So a lot of room to grow. I just think it's ahead of itself over the short run. If I were to buy one, I think I would buy Microsoft, because you not only get a little AI, but you also get the cloud. And so I think it's a cheaper, safer way to play it. Maybe not 100% pure play, but I think you get a better value by buying, something like a Microsoft over an Nvidia. And when you get into the smaller cap world, they tend to be a little bit more volatile and maybe too much exposure. So I think I'd let it get one of those companies get to be a little bit bigger before making an investment in one of those names.
Let's say a sector is doing well in one year. Normally, the following year it's not doing as well, and also, vice versa. Those that are not doing as well the previous year does well the next. In fact, I think very rarely has a sector done good twice in the consecutive years. So, like, give an example, like last year, technology did very well, but energy didn't do well at all. Now that we're in the beginning of 2024, where do you see the hot sectors this year to be?
Yeah, and I couldn't agree more, because like I was mentioning about 2022 versus 23, I mean, technology down 35 and then up 45 and 23. It's just kind of wild looking at those 2 years. But I think this is going to be a good year for cyclical value stocks. I think you're going to get a little bit of growth, So no recession. That's not in my forecast, but a little bit of growth. Inflation sort of stagnant. Maybe it comes down a little bit, maybe not to the 2% level, but in that environment, I really like things like energy. I like financials, and I think when you see some of the news and what kind of happened, maybe it kind of peaked October of 23, where a lot of these banks were under a lot of pressure. Signature Bank, the others that just Republic Bank that folded. That sometimes can offer an opportunity in some of the regional banks that are high quality, sticky deposits, and maybe not a lot of exposure to office and commercial, and might allow somebody to have an opportunity to buy a very high quality regional bank with some of the other ones that had some bad loans and that sort of thing. So I like financials, I like energy, and I like just cyclical value in general, including real estate.
Loans. There's a lot of loans that are going to be coming due this year. I want to say something like a half a billion, 500 billion, not half a billion, 500 billion. But also in the next couple of years, there'll be something like $2 trillion of commercial loans coming up due. Well, they're not going to be able to get the same interest rate as landlords had before. So that means banks will either have to roll them over or do something else. Do you see a reckoning about to happen with regional banks or other loan institutions?
I think you got to be very careful when looking at regional banks. The money centers, the JP Morgans, the Citigroups, the Wells Fargos, they've got a lot of things they can do, a lot of levers to pull to not have that exposure. But some of the regionals that are overexposed to that, it would be a very scary place to be invested right now. And that's one of the first things I would look at, are kind of making sure the deposits are sticky, first of all, but looking at the exposure, especially to office that doesn't appear to be doing well. And, with the backdrop of looking at the whole economy, right? 34 trillion in debt. Now our interest on the national debt is, 745 billion a year. So you look at that and you look at some of the financials. I think just in general, just one of the reasons why the Fed just can't keep rates, higher for longer. Eventually they got to cut and give some of those regional banks some relief, because there is a day of reckoning. And I agree with you completely, Andre.
You brought up about REITs, and I'm sure a lot of, let's say, your clients and a lot of our viewers like dividends, and one thing are real estate investment trusts that pay an interest rate. Well, with commercial REITs, is that an area that maybe an investor should be leery of or wanting to stay away from because of what we were talking about?
I would look carefully at what you're invested in, because you can buy a REIT on storage units or certainly pipelines or whatever it might be. And so I would just be very careful about what type of REIT you're investing in. And then other things for taxable investors, they should always remember that REITs are taxed at ordinary income, which can be more like fixed income, so a little bit more expensive than when you buy a stock in JP Morgan and only pay 20% interest rate on that, 20% tax rate on that dividend. So I'd just be cautious about that when people are looking at that after-tax yield on a REIT versus just a regular stock.
Well, thinking about pipelines and with energy last year in 2023 was a low sector that didn't return well at all. Do you think now that we're in 2024, what are your thoughts on the energy sector?
I really like energy a lot. In fact, I don't think I've owned an energy stock in 7 years. It sounds kind of incredible, but we just bought a small company called Atlas Energy. AESI is the ticker, but it's really a logistics company, and really, I guess it's a mining company of sand, but they're delivering the sand and mining for it to all their customers in the Permian Basin. So currently they're building a 42-mile, conveyor belt system to deliver all of their sand to all their customers. And so it's a very nice cash flow story. A guy named Bud Brigham runs it. He's been successful in the past. It just went public the beginning of last year. So it's something that a lot of people don't know much about now, but I'll be down there February 19th, and I'll be visiting the company and just taking a look at the construction they've got so far. But it should be finished by the end of 2024, and I think that's going to do really well for them. And so that's my kind of chicken way of getting energy exposure. But I think the sector is going to work in 2024.
What are your thoughts, Sandy, about when it comes to the energy sector? And I know this is a political season right now, so you've got one faction that says, we want to do away with energy which is fossil fuels. We have another, and we're just going to have just solar. can we actually do away with, I mean, we're going to be on fossil fuels and other types of that type of natural gas energy for quite some time? Or do you think that the investors should be concerned about going into that sector?
I think we'll be on fossil fuels for as long as as long as I'll be on Earth, I guess. So I think it's going to be a long time. So yeah, there's always going to be political bantering about it and that sort of thing. But at the end of the day, people need to get from A to B as cheaply as possible, and that seems to, fossil fuels seem to be the best way to do that. So I think it'll be a while before anything, turns around from that perspective.
Now, we talk a lot about domestic stocks. Do you look ever for European, foreign, international type of investments?
I do think that international is kind of an opportunity. Now, we don't invest in foreign domiciled companies. So we own a company called Euronet Worldwide that is actually based in Kansas, but it's got 90% exposure to Europe. So we tend to buy things that are domiciled domestically, but have exposure over there. In fact, I'd say it's hard almost to find a company that doesn't have exposure over there at this particular moment. But yeah, we tend not to buy foreign companies, but I do think there's opportunities, and I like this business a lot, which is almost like a Western Union where they're moving cash between different countries, and in Europe it's just a lot more. I guess so many other countries, just people moving money all the time, and of course for a small fee, which is how they make their money. So they just had a nice quarter, and a company I like a lot in that region.
Do you see any geopolitical risks that may worry you or keep you up at night more than other things?
Yeah, I mean, I think more now than ever, right? I mean, what's going on, whether it's Russia, Ukraine, or what's going on in whatever happens with China, there seems to be just more turmoil than there has been in quite some time. So that's always one of those, black swan things that you sort of think about and what could happen. But you just hope that we get through all these issues, and everybody is as safe as possible. So hopefully short-lived, and we press on from where we are now. But certainly something that you've always got to wonder about in the back of your mind, as far as pretty major geopolitical situation that could be going on at any time.
Sandy, I know I get emails for doing this show, so I know your clients must surely ask you. I know when it comes to cryptocurrency, the last time we talked, there was not an ETF, but now there's an ETF for Bitcoin. If your clients call you and ask you about your thoughts about being involved in an ETF for crypto, what are your thoughts?
Yeah, I've been pretty negative and really wrong for being so. But my problem is it's really when you have a non-fiat currency and it's really not backed by any dollar, I have a hard time coming up with a valuation. I have a hard time figuring out what is the intrinsic value of a Bitcoin, how many other cryptocurrencies can be produced and come out that could put pressure on existing currencies. So, I think blockchain is an amazing technology, moving, fiat currency, from moving dollars from A to B, or different, through different banking institutions, et cetera. But when it comes to crypto, I've sort of just taken a back seat, and I'm going to watch this one play out probably from the sideline, unable to value, where it should be today versus 6 months from now. So that's how I feel about it.
Sandy, it sounds like you've read my answers to my emails for my viewers. That's my thoughts. We've got a lot more, Sandy. I hope you come back.
Thanks for having me, Andre. I really enjoyed it.
Thank you, Sandy. Hey, if you've got a question, maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us at andre@benecapital.com. Now for a wrap-up on Wall Street. Seattle had been the home of Jeff Bezos. Jeff is the founder of the one-time CEO of Amazon. But he, along with a lot of other billionaires, are moving to tax-friendlier states such as Florida or to Texas. Well, Jeff Bezos this week sold 12 million shares of his company for an estimated $2 billion and is expected to sell another 50 million shares between now and January of 2025 for an estimated $8.7 billion. Now, part of that money is going to be going to not only his new home in Florida, but for a new $500 million yacht that he's building. But here's what he bought the yacht in just savings. By moving from Washington State to Florida, Bezos avoids paying Washington State's new 7% capital gains tax. Now, that state had just started it. So he'll be avoiding paying the $600 million in state taxes that he would have paid, and he applies that to the $500 million towards that new yacht, while saving $100 million. Disney employees portraying characters at Disneyland and Disney World are seeking to be unionized by the Stage Actors Equity Union, representing 1,700 employees in the characters at the theme parks, like Mickey, Minnie, Dumbo, and all the other card-carrying now union members. Then I guess it really will be a Mickey Mouse organization? And speaking of Disney, do you know what happened 74 years ago today? Well, the animated movie Cinderella debuted by Walt Disney and became Disney's biggest hit since Snow White in 1937. And it was one of Disney's biggest hits, making over $93 million at the box office back in 1950. And adjusted for inflation, that would be over $500 million in today's dollars. Finally this evening, we've been together Friday nights for the last 3+ years. On my first show, I said my goal was to bring you stock market information along with interviews of financial newsmakers that help shape our financial portfolios and hopefully make it entertaining at the same time. Wall Street Wrap-Up is going to be going on hiatus on these Friday nights for a while, but I want to say a huge thanks to the people that you don't see but couldn't make the show without it. I'm talking about Calvin Barrett on audio for making me sound much better than I normally do, or Stephen Patriquin for all his help in my scripts and interviews in getting the show together. And finally to our director, Mike Kaler, for every Friday night pulling off the impossible and making me more presentable than I really am. So when I do return, I hope you welcome me back into your homes as you have for the last 3 years. And that's a wrap-up on Wall Street Wrap-Up. Our thanks to Sandy Villere for being with us this evening. Always, though, we appreciate you for allowing us into your homes tonight. Have a fun weekend with the ones you love. Remember, money never sleeps. I'm Andre Laborde, and this is Wall Street Wrap-Up. Good night.